We'll briefly go through some patterns and simple tools that you can use in conjunction with your fundamental analysis. And there are 3 different speakers on this talk. I'm the current head of education at the Society of Technical Analysts, and I'll be joined today by Nicole Elliott, who is a fellow of the Society, and also Stephen Hode, who is trading the markets professionally with his own fund, and he will show you how to apply all this theoretical knowledge I'll start off with. So we all know about fundamental analysis. I'm not going to go into this, but I just want to emphasize that technical analysis is all about market price. And technical analysts also look at volume when they have volume data available to them. Another thing we look at is sentiment. So these are the 3 things technical analysts usually will focus on. And obviously we can do quantitative analysis on both the fundamental side, but also on the technical side. So what exactly is technical analysis? It's the study of past price action, primarily through the use of charts for the purpose of predicting future price trends in the markets, according to John Murphy, who's written a book called Technical Analysis of the Financial Markets back in the 1980s. And this book is still being used to this day as one of the reference books in technical analysis. So technical analysts do not seek to establish the value of an asset, but we are interested in studying the price of an asset. And we want to see what the trend of that asset is and whether that trend is likely to continue or not. And with trends, we mean an uptrend, a downtrend, or a sideways trend. So we are not interested in fair value. We don't believe in the efficient market hypothesis. All we look at is the price and derivatives of price in order to forecast what is likely to happen in the future. So what are the core tenets of technical analysis? First of all, market action discounts everything. What this means is basically that we believe everything that can be influencing a financial market is already priced into its price at any given point in time you're looking at it. Because the price is nothing else than the difference between demand and supply, as we know. And what is happening is basically that any new information, be that fundamental data, information, fiscal policy, monetary policy, geopolitical events, any things like that will be priced into the market very, very rapidly. And therefore it will be reflected in the price. And if you study the price, you can see what it is doing and what it's likely to do. We, as I said, believe in trends, and therefore we don't believe that markets are efficient. We believe that markets move in trends, and there have been more and more studies done over the years, but there are also older studies dating back to 30 years or so, which prove that momentum investing does actually work. And then history repeats itself. Markets basically reflect human behavior. And this is all in John Murphy's book. And I'm going to show you just some very simplistic tools that you can use in conjunction to your normal analysis in order to gain an edge. So, in summary, markets are not rational, since human emotions like greed, hope, fear, etc. are driving these markets. So it's not the data itself which is driving the market, but how we interpret that data and how we are being influenced by our biases, by our colleagues, by our peers, by our competitors, by news flows and things like that. And to illustrate this, I've got a cartoon here today with me, drawn by Kevin Kelleher, who is the editorial cartoonist for The Economist magazine. Some of you may know this already. And it's called Just a Normal Day at the Nation's Most Important Financial Institution. So we've got a person here saying, I've got a stock here that could really excel. Really excel? Excel, says the next person. Sell? Somebody hears? Sell? Sell, 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 sell. Everybody's going crazy. Everybody's selling because we are selling the market. And then this continues and it becomes a frenzy. Sell, 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 sell. Until somebody just says, this is madness, I can't take it anymore. Goodbye. 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 Buy, buy, buy. And then it becomes a frenzy. Buy, 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 buy. Now, I know it's a cartoon we're looking at, but it does actually reflect financial markets, especially at extremes, especially when markets are making a low, when people are really, really scared, when all these emotions come out, and we as human beings do not then act rationally anymore because we are being swept away by all this mass psychology in the financial markets. So in summary, looking at technical analysis compared to fundamental analysis, we know that in fundamental analysis, we have delayed data because we have to wait for the data to be published. And that isn't often is often the case after a month or two or three, etc. We know that data gets revised. We know that sometimes the data is fraudulent. I mean, look at Wirecard, for example, a few years back. And we also have a lot of variables to contend with. And that makes it very difficult to try and build a model which is stable and which can forecast what price is likely to do in the future. And then last but not least, fundamental analysis, as you know, disregards human behavior because it believes that markets are efficient. Now, on the other side of the equation, you've got technical analysis. And what we do is, as I just said, we only look at the price, and the price is instantaneous. It's just the difference between demand and supply at every given point in time. So there are no revisions in the price. The data is true, and it is just one variable we look at, the price itself. Now, obviously, we look at derivatives of the price, oscillators and indicators built around the price, but still, it's just one variable we at the end of the day look at. So it makes forecasting far easier than looking at a lot of different variables as you do when you do fundamental analysis. And last but not least, sentiment is also something very important in technical analysis because we try to see how human behavior influences the price, and we can spot that from a technical perspective, and that can't always be done from a fundamental point of view. So before I show you some charts, I just want us to be all on the same page, and I'll be looking at candlestick charts. And we'll take questions later on. I'll see here that some people have asked questions, but we'll take these at the end of the presentation, if you don't mind. So the candlestick charts are basically in the Western world, green or blue when they're pointing up, meaning that if this were to be a daily candle, for example, the close is above the open, and it would be red if the close is below the open. So red is negative, close below the open. And here in my examples, green is positive, the close above the open. And then you've got these things here, which are the shadows, and then the high price and the lower price, but we won't bother with these today. So can behavioral finance stroke technical analysis spot what fundamental analysis cannot see? And yes, it can. And one example is divergent and divergence, basically. And what this is that if you have a market and you build an indicator or an oscillator around that market, so basically just a derivative of the price you're analyzing of that asset, then you would expect the asset to react in a similar way to the derivative of the asset to react in a similar way to the underlying asset. So the derivative of price, if the price is going up, you would expect the derivative of price to also go up. When the market goes down, you would expect for example here, the momentum indicator to also go down. But when you make a new high in the price and you make a lower high on the indicator, it is telling you that the uptrend in the price might not be as strong as it might look on the chart. And you could have at least a correction or a reversal in the trend taking place with a pretty high probability of being right. So let's look at this example here, the FTSE 100. And we can see that on this chart, the daily chart from a few days ago, we had a high in early February, which was marginally higher than the high in January. So prices were going higher. But at the bottom here on this chart, you can see this orange line, which is the relative strength index. It's a derivative of the price. And you could see that that was actually pointing lower. And this is called negative divergence. So when that happened, it was warning us that perhaps the uptrend wasn't as solid as it might have looked at that point in time, and that we could at least see a correction. It turned out to be more than a correction and quite a sharp sell-off. The same happens in reverse. If you have the market making a new low, you would expect the oscillator to make a new low, then bounces with the price. And then if you have a lower low on the market price, on the underlying asset, but you make a higher low on the indicator, this is called positive or bullish divergence. And this is what we saw on the Nasdaq 100 on this chart, which is a few days old. And you can see on this daily chart that we made a lower low in mid-March compared to the February low, yet our oscillator here at the bottom, the RSI, was making a higher low. And this was forewarning us that we could see a reversal in the trend on this market. Now, technical analysts also look at patterns, and I'm just, for illustration purposes, going to show you a very quick one here. And this is the double bottom formation. And what happens is that a market makes a low, it then bounces off the low, and then retests that low, and either slightly above the previous low or slightly below the previous low, makes another low. And when you then have a move out of the pattern, which takes you above the midpoint of that pattern, which looks like a W, then you can take the distance from that midpoint and project it to the lowest point of that formation, so the low we saw in the Nasdaq. And then you take that distance and project it upwards from the breakout point, in this case at 14,395. And this then gives you the upside target, which is close to around 15,800. So this is just a very simplistic example of some of the patterns that technical analysts might be looking at. Now, very quickly, I'll show you a pattern on candlestick charts, and this is to do with reversals, which quite often happen once you see these. You have bearish and bullish engulfing patterns. And what a bearish engulfing pattern is if you have an uptrend, so the green candles here, followed by a higher open than the previous day's close, the market making a new high, but then reversing lower and closing below the previous day's open. So this body of this candle, the red bit here, if you were to move it to the left, would completely cover or encompass or engulf the previous bullish candle. And this is a reversal signal to the downside. The same happens to the upside if you have a bullish candle following a bearish candle and engulfing that one. So let's just look at these. Can you see the low we had here in the Nasdaq in mid-March? So not only did we have our positive divergence, but we also saw this reversal pattern on the chart. So we could see a bullish engulfing pattern here emerging, and you can then see we broke through the downtrend, and then we accelerated higher and moved up to the 200-day simple moving average, which is this red line here. And you can see that I drew a box around this because I also connected that with previous lows and highs. So technical analysts often use old highs and lows to see whether the market could potentially stall in these areas because they might act as resistance. And as I said, we also had the positive divergence. So it's like a puzzle piece. If you have more and more different indicators and trend breaks and moving averages and other tools you can use in technical analysis coming together, giving you the same signal, then you can have a high probability outcome of being right with regards to the forecast that you're making. Now, I talked to you about the bearish engulfing pattern earlier on. You can trade it in different ways. The most conservative approach would be for confirmation of the bearish pattern to be seen. That would be a next candle, which is bearish as well, in which case you would go short at the close of this candle with a stop loss above the pattern here at the high. Now, a lot of traders don't trade it that way because what they think will be happening if they have seen this sort of candle is as soon as on the next day you fall below, for example, the close here, you then also go short. So you would get an earlier entry, but you run the risk there that you might not have the next candle confirming the pattern. But that's what some people trade. But irrespective of that, just look at the beginning of February high we saw here in the Nasdaq 100. And you can see we had a bearish engulfing pattern, which led to a few days of downward movement. You can see again here towards the middle of the month of February, we had another bearish engulfing pattern, which then led to a strong decline. And you had another pattern here, which is also a bearish engulfing pattern at the beginning of the year, which also led to a huge decline. So you can see how these patterns on the Nasdaq in the last 3 months have clearly given us very powerful, good risk-reward trade setups in the right direction of the trend. Now, I'm going to finish up my part of this presentation very quickly with correctly drawing trend lines, because a lot of people do this incorrectly and then wonder why it's not working. So in order to correctly draw a trend line, what you need to do, you find the lowest point of your chart, you go as far as possible back on your chart to find that point. You connect at least 2 points and draw a line through these. This is then called a tentative trend line or support line in case of an uptrend. And then you make sure that no price data is below your trend line. I'll show you that in a minute on a chart, it'll be much clearer. And once you connect 3 points or more, a trend line is in place. So the correct way to do it is to take the lowest low, connect it up with the next higher low, and then a next higher low, without any data going through that. This is for an uptrend, and in case of a downtrend, you connect the lower highs. So this is the S&P 500 daily chart going back to the pandemic low, and you would take that point here, the lowest point on your chart, to draw your uptrend line. And you can see this would be a correctly drawn trend line because we wouldn't have any data going through there. Now, if you drew it like this, you would have to redraw it. Why? Because you had data going through this point. Up until the beginning of December, so had you not known what's happening in this bit here, this trend line is correct because it connected up these lows with these lows, and there was no data going through the trend line. But at this point here, what you need to do is just redraw the trend line so that you don't have any data going through it. If you do that, then the trend line is just valid. It's just become flatter. What you can also do is look at shorter term trends within the long-term trend, and you can take any consolidation period and from then onwards draw a trend line. But what you can't do is have any data going through that. So this trend line would be incorrect. This one, however, you can see we went sideways here and then we started a new uptrend. From here, you could draw a trend line up, and this one is correct. And then once you break through this trend line and you fall through the latest low on the actual candle here, that's your signal that the trend has been broken. Quite often what then happens is the market tries to retest the trend line but fails and then comes down. So this would be the correct trend line from the lowest point drawn on this chart. And we have seen that once we broke the trend, we went into at least a short-term downtrend. You can do the same on the downside here. This is an S&P 500 daily chart. Had you drawn this line in here, and then on this day you had a break above the trend line, as I just said, what you need to do is just redraw the trend line so that no data goes through this point. And then what you can see here is that we actually have a channel in place, because if you take that line and project it to the downside, to the lowest point here, we have a downtrend channel in which the S&P 500 has been evolving. It's now broken out of that since. So this would be the correct way to draw a trend line. In an uptrend, you take the previous trend line you had in place, and then you put it and parallel move it to the highest point of your data series, and this gives you the uptrend channel. In case of a downtrend being drawn, you take that line and just parallel it down to the lowest point on your data series, and that gives you then the downtrend channel. So here is a channel drawn on the cable chart, cable, so British pound against the US dollar, and you can see that between late February and mid-March, we were in a downtrend channel, and then we have broken out of that since.